Now let's talk about a derivative. A derivative is an instrument whose value depends on or is derived from the value of another asset. In other words, a derivative is something that depends on the value of other things to change. The examples in financial market can be futures, forwards, swaps, options, exotics. All of these are betting on the change of some other financial instruments. So why derivatives are important? Derivatives plays a key role in transferring risk in the economy. Now, every time you invest, you incur risk to you. The risk means that your investment could go up and could go down. To reduce the exposure of the risk for an individual parties, this individual party could choose to trade derivatives with some other parties who either bet on the upside or the downside, and then they can exchange transactions, and then so the original party get a lower risk exposure in exchange for lower profit level. The other parties, if they bet right, they make a lot of money. If they bet wrong, of course, they expose downside risk. In a sense, instead of one party taking the profit or loss, the entire risk, now you have several parties to share the risk. The underlying assets include the stocks, currencies, interest rates, commodities, debt instruments, and then for things like electricity, gas, insurance payouts, weathers, the grains. There's many things that can be the underlying assets of the derivatives. And the many financial transactions has embedded derivatives that make them kind of essentially cheaper to conduct, because there are many other parties, people at large, the investor at large, are sharing the up and down through derivatives. The real option approach to access a capital investment decision has become widely accepted, because this is a reasonable bet, reasonable projection of how things will go in the future. How derivatives are traded, and then they, like other things, they trade in exchanges, like the Chicago Board Option Exchange, CBOE. But for derivatives, most of them are traded in the over-the-counter OTC market, where traders working for banks, fund managers, and corporate treasurers contact each other directly, and they're trading a big chunk of investment, not a small amount of money involved. And prior to 2008, the OTC markets are unregulated, and that's why it gets so popular. And bank acts as market makers, quoting bids and offers, and then each trade usually defined by master agreements, and then both parties come to this basket agreement to conduct their transaction. And sometimes they use something called CCP, Center Counterparties, to handle the transaction. A CCP is just like sort of ad hoc exchange, and it's guaranteed for both parties safe and trustworthy transactions, but it's not kind of long-standing entity there and for day in, day out retail operation like exchanges. After financial crisis in 2008, OTC market has become regulated. The reason is the OTC market has been believed to be one of the big reasons that's causing the financial crisis. The objectives of regulation is to reduce systematic risk and increase transparency. Systematic risk is, we all know, when everybody share the risk, and then everybody could go down together, just like in 2008. Now we want to reduce that kind of risk. In US and in some other countries, standardized OTC products must be traded in a facility called swap execution facilities. It's also similar to exchanges. And CCP must be used for standardized transactions between dealers in most countries. So you cannot use everything through CCP. Now it's called standardized transactions. Now, after all trades must be reported to central registry, so everybody can have a chance to look at it if they want. So this graph clearly shows while OTC growth is like runaway trains between before 2008. After 2008, when the regulation getting strong, the OTC market that's kind of peaked. They no longer have that kind of growth rate.